the most risky combination you can make in any business investment, but Q4 inventory for sure is place a huge investment bet with short-term debt that is due right after knowing whether the bet was right or wrong.
People get locked into the idea of, oh my God, I can make X profit dollars in Q4. What if I don't? And how much can I lose in Q1?
Dylan, we're back. Episode 19. What's cracking, man?
Not much. Excited to chat about demand planning. It's a fun one. Q4 ready. Do you buy more stuff, less stuff? So it's a delicate balance.
I've been thinking about what functions or activities live at the intersection of marketing and finance. And actually demand and replenishment planning is one of those functions that is like very much at the center of the connection between finance and growth marketing. If the demand plan is wrong, it impacts both of us, right? In varying degrees of ways. And it's something that I don't think gets talked about enough as one, an enabling driver of growth marketing success, right? As well as like the impact that it has on cash flow when done well or when done poorly. And so I'm excited to dive in to this. To get us started, I'm curious, like, how often do you guys see on the agency side of the world poor demand planning actually make it harder to help grow a brand?
It really depends on the category. So like in our experience with like CPG or like replenishable products, just in general, a lot of these stores have fewer SKUs. So that then leads to less likelihood of getting things incredibly wrong. Like I think when you have a lot of items, you diversify focus and you're spread more thin across more things. And then you also have some benefits of CPG being generally replenishable, that like in the event you over order, because of that like replenishable piece, you often see like maybe instead of over ordering for a year, you ordered like 6 months worth of goods. So that's less common. The most common thing we see is like a high SKU count store with a lot of the predominant sale being driven by new customers, often ads, which have some volatility risk. And essentially in the what can occur is you can actually have stores that are profitable, but seeing like negative cash flow because they're selling the wrong things and they're buying inventory and they have unproductive inventory. And we see that, unfortunately, a good amount, especially when you're talking with like brands like between 1 and 10 million, we find they're still kind of learning that demand planning function. Yeah. And that can sometimes occur.
I see that a lot on the CFO side of the world. We've talked a lot on previous episodes about like new product introduction strategy and decisions. I see a lot of it, unfortunately, get baked into that first order or the first couple of orders that get placed for new SKUs or a new product category. And the amount of time it takes to right size that inventory, I see it take oftentimes on a bad first 1, 2, or 3 orders, like literally a year or more to right size the inventory. And the challenge is, to build on one of the points that you were just making, is like when you have capital tied up in a slow moving SKU, but you really need to start reallocating capital, you're short on fast moving SKUs, right? You start having this very challenging trade-off of like, man, I need more capital to buy inventory and it's tied up in this stuff that won't move. And meanwhile, I can't hold on to the stuff that's actually selling, right? And so it's actually obviously very tied into previous conversations we've had about merchandising and new product introduction and whatnot. But I'm also curious, like, how involved do you guys get to be or try to be on forward-looking demand plans as you start working with a brand for longer and longer and longer?
Yeah, so it really depends on like who we're working with. Different brands also have like different internal controls when it comes to inventory planning. Like some brands we work with have like dedicated inventory planning teams. Some surprisingly large brands, it's just the founder doing it with like, and oftentimes that's when the like SKU counts are lower. So like it really can vary. Most commonly at Aplo, we're basically going to be looking at historical sell-through data and estimating based off of top-line volume expectations and seasonal trends, which SKUs may be moving X number per month by SKU, variant, etc. That's a somewhat common exercise that sometimes our clients will ask us to generate. Ultimately, the arguably harder part than just that is then deciding when and how much to purchase, which is a little bit outside of our like standard scope. But sometimes we'll have conversations about strategies in terms of how you can think about placing POs and kind of adjusting the sizing throughout the season. Obviously, we're chatting about this mid-August, so I'm sure you and I are having more conversations than normal with brands about like how much to order. I think one of the previous episodes you were saying how a strategy you like when possible is like having a boat order shipped, and then also you can supplement with air order. I think that's a conversation we have a good amount too, is like strategies to kind of like hedge your bets a little bit. Overall, I'd say that it's something that comes up more commonly for the higher SKU count stores. How about you guys? Any like big interesting situations coming up ahead of Q4?
Well, I mean, we have several brands that we're working with that have grown significantly year over year for the last couple of years, who are currently trying to place the biggest orders that they feel comfortable with for the fourth quarter. And so we're working hard in large part on the financing strategy for those. And like really, when we think about the financing strategy for these orders, we're trying to help them. It's really like, hey, we're trying to enable you to be able to place a bigger bet and feel like we're comfortable that it's a still good risk adjusted bet. And so like we're working on trying to structure the right capital, because as we've talked about in previous episodes, like certain forms of capital for big Q4 purchases are riskier than others. So like we're hard at work right now trying to get multiple options of debt financing, negotiate them against each other, stack them against each other, and see like really which one can enable the biggest order that also mitigates risk. The other thing is like, when we were kind of preparing for this, I was trying to think through like, besides historical data, right, which is super important. Like historical sell-through data is incredibly important because you need something to inform, not just like total inventory that you're purchasing, but like SKU mix, right, and the breakdown across SKUs. But I was trying to think about like strategically when a brand asks us for help with replenishment planning, inventory replenishment planning, like what are the things that we help them think through? So I put together this like short list that I hope is helpful for people listening. The first one is like, and feel free to jump in and stop me on any of these, Dylan, if anything comes to mind to add. But like the first one is capital availability and cost of capital. And what I mean by this is like, if you don't have capital, then you can't, it doesn't matter how much you want to buy, like you don't have the capital, right? And there's also, as cost of capital goes up, right, the cost of either equity or debt, whatever it is that you're using to finance inventory purchases, as that goes up, you have to think harder about how much you're purchasing, because it's going to cost you more to hold on to excess inventory just from a cost of capital standpoint. So like those are constraints that you have to consider, and you have to have the right makeup of capital availability and cost of capital to place orders. The next thing that I was thinking about, this is something we dealt with at Guardian Bikes a lot. And what I'm really about to get at here is that like sometimes you have to diverge from historical data and like diverge from the optimal, like the optimal purchase quantity for various strategic factors. So one of those reasons you might have to diverge is you have a key component you can't stock out of. So I learned this lesson at Guardian Bikes. Our secret sauce was our patented Sure Stop brake. All of our bikes had Sure Stop brakes. If we ran out of Sure Stop brakes, we couldn't make a Guardian bike. And so it's very critical. There's no substitute for that particular component. And they were cheap. So we actually didn't order an optimal quantity from a cash flow standpoint. We had we put a minimum stock level. And it was a fairly high min because it didn't cost us that much money. It didn't tie up that much capital. So we always kept a very high minimum stock of that because it was a key component. And I kind of think about subscriptions or like subscription inventory available to fill subscriptions, existing subscriptions in a similar light. There's a couple more things on my list, but I want to ask you I want to dive deeper on the subscription piece. Like, do you guys ever get involved with like talking with brands to ensure that they don't run out of subscriptions when you've got a growth marketing plan that is like very focused on driving, subscription opt-in and retention and whatnot?
Yeah, I think that is like a conversation that we have a lot. And like as you get better at revenue forecasting, especially like by breaking it out first versus returning, you can make an argument to like borderline have like safety excess stock just for the return customer sales. Like if you sell out of an item on ads that would have sold out from return customer revenue, you lost money and opportunity cost because there was excess margin there. And yes, subscription, you kind of have to, like, in my opinion, set aside and treat it as its own bucket because you want to make sure you can fulfill those. But how you kind of think about like the expected sell through by SKU, I really, really, really think that you want to think about it in terms of through the lens of like maximizing the profit per order. And you want to make sure that the SKUs that specifically have, like, if there are certain acquisition SKUs and retention SKUs, I'm actually more inclined to be a little bit more overstocked on those retention SKUs because those are probably going to be my most profitable orders. Now, at the end of the day, there's risks on both sides of the equation, but we're talking like strictly about profit per order. That piece is definitely something that we keep in mind. I guess like on your side, Jon, I know you've chatted about this a bit before, but in terms of like the financing for the inventory POs going into Q4, are there any best practices that you're thinking of the most right now?
The most important best practice, I would say, after you've clearly assessed risk, which, I can highlight that because we talk about that a lot on this show, but like if you've assessed how risky the bet you want to place is, right? And factoring in your new customer dominant versus, a heavier LTV brand, how big is the bet and how much uncertainty is in how big you're in your sales forecast aligning with that big bet. Like the biggest thing is like you want to take on an amount of debt that like you feel like you can pay back, you could forecast that you can pay it back with a sales scenario that you feel very confident in hitting, right? And alongside that, to the extent that you can, push out any balloon payments, like big principal payments that are due, as far off into the future as possible. Like I've said it before on the show, but like, hear me again. If you like, the most risky combination you can make in any business investment, but Q4 inventory for sure included, is place a huge investment bet with short-term debt that is due right after the time horizon of like, right after knowing whether the bet was right or wrong. That's the worst thing you can do. Real estate, stocks, inventory purchases, I don't care what it is. You want the payment for the debt to be paid back as far after finding out it didn't work as possible so that you have time to figure out how to pay the debt back. But furthermore, you want to run cash flow projections where you're like, here's one thing that I like to do with brands. When I feel like a brand is going really big, I'm like, I'm nervous about this. Like when I get nervous about a Q4 PO, I'm like, what if we hit 50% of our sales forecast, of our like most rosy picture, like best case scenario forecast? Will we still have enough cash to pay this off even if it's going to hurt? That's like a starting point. And when I see that we are, and then I go back and look at historical data and I see like 50% of our sales forecast, how much is that compared to last year? If it's like a reasonable like growth rate, I'm like, we're probably going to be able to pay this off. If I'm still nervous about that, then I'll go down to 40, 30, whatever it is until I start going like, okay, like we need to pull this PO back, right? But show the founder. Most of the time that scares founders. But if someone's not scared, then at least I go, okay, I just want to say before we place this, we are saying we feel 100% confident that we're going to at least hit 50% of our sales goal. And if so, this is how tight cash is going to be. And I'm suggesting we probably cut this, 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 and this to also survive. So before we place this, are you saying you're okay with that? They're like, I am. I'm like, okay, at least I have helped them. I may not personally agree with the bet, but I helped them define the bet and the risks. And so, hey, we're going for it.
I've just seen too many large POs cause issues so many times with like
Totally.
overconfidence that I just always tend to veer on the side of like, yeah, like you should have a base case forecast. You should have some scenarios when it comes to inventory and how you think about that how you think about managing that from a cost perspective. I would like much rather sell out than have way too much. I think one of the ways to frame it too is in your scenario planning, looking past Q4, because I think a lot of people will forecast Q4 and not forecast Q1 when you're talking about that. Like if we have 30, 40, 50, 60%, whatever it is of our estimate targets, what does that mean for Q1 financials? Because I think people get locked into the idea of, oh my God, I can make X profit dollars in Q4, and I'm super excited about that. Whereas in Q1, even if, what if I don't? And how much can I lose in Q1 if I mess up in Q4? So I think that you have to look at both Q4 and Q1 in a way when doing Q4 demand planning, because without that Q1 context, I just don't think you can properly manage the downside risk.
Well, and that's actually a perfect example of why we as CFOs, our standard process is we do rolling forecasting. We'll have a plan for the year, for the fiscal year, the calendar year, to see if we're tracking to that, right? Because usually there's like an annual goal, but we do rolling forecasting. Every single month we roll forward our financial model 1 month. And so our clients look 12 to 24 months into the future in our financial models. And so if the forecast time horizon is 12 months, every month we slide that forward 12 months. So we don't ever look forward less than 12 months. A lot of brands that we work with are highly seasonal, and the only way to make good decisions is to look 12 months at a time. In fact, we always have to look 12 months in the rearview mirror too when we're assessing like true pacing. We always have to look trailing 12 month because there's such a delta between the peaks and the valleys of a seasonal brand. You have to look at 12-month increments. And so I totally agree. And furthermore, a lot of the brands, this isn't all of them, but a lot of the brands that we're working with right now that are placing big bets for Q4, they manufacture overseas. And actually that brings me to another factor or a constraint that may cause you to place not the quote optimal mathematical quantity of POs, is that there's supply chain constraints. If you're a brand who's making a CPG product, let's say it's a supplement, and your supply chain's in the US and it's a fairly low lead time, like 30 days or something like that, or even just a couple of weeks because you have a domestic supply chain, well, you can afford to purchase less. You can commit to less months of inventory, less days of inventory every time you place an order because you have a shorter lead time. When you're purchasing from China and you're putting stuff on a boat to get maximum margin, gross margin per order or per unit, you have longer lead times. And so you're committing to multiple months of inventory at a time. So if you're projecting out massive growth, you actually have to commit to multiple months of massive growth, right? So you're placing a bet on multiple months worth of sales forecast. Whereas if you have lower lead times, you may be only placing a bet on 1 month of big growth. And so if you're off, you can adjust the following month. When you have to place a huge order from China, here's the other thing that's a big issue. Not just lead times, Chinese New Year. So there's production capacity limitations. And so with Chinese New Year, the factories shut down for, I've learned over the years, just assume it's going to be 5 weeks, even though they say they're only going to be out for like 2 weeks, but production never ramps back up like quickly. It always takes time. So you have to look at seasonal production capacity limits, right? Effectively, what it comes down to is every brand we're talking to right now that's trying to place a huge order with a Chinese manufacturer for Q4, they're actually looking at placing orders all the way through their demand forecast for about April, typically. Depends on where Chinese New Year lands, but March to April. So now you're actually looking at probably November, December, January, February, March, and maybe April.
Yeah.
And So the scary thing, the real scary thing is if your forecast for Q1 and even April, the beginning of Q2, is predicated on the momentum you're going to come out of Q4 with, if you come out of Q4 with way less momentum than you thought, all those months, all those future months baked into that PO, that forecast is off too. And so that's why from a CFO perspective, for those kinds of brands, we are trying to kick debt payments as far out into the future and really help brands pressure test the risk of those purchases, because those constraints with supply chain force them to have to place even bigger orders.
And what are your thoughts on, like you have noted here, the delta between ocean and air freight? Is that basically like deciding how much the gap impacts how much you would purchase one over the other, or one way over the other?
So for example, I know some apparel brands, I'm sure you guys do as well, where they can ship air. We would love not to, but they can still turn a profit. They still have positive contribution margin per order, or gross margin dollars per order. Guardian bikes, we could not ship air because bikes via air, they don't pencil out.
That sounds like you're basically booking a plane ticket.
Yeah, exactly. No, seriously. And so what I'm saying is, like, if the delta between ocean and air freight for, let's call it generally smaller, lighter freight, right? Smaller, lighter items, the delta between air and ocean is a tighter delta, meaning switching from one to the other, namely switching to air to take advantage of a shorter lead time and catch up on inventory. If you order too little, you're giving up less, but the bigger and heavier the package is, the more unlikely that you can even be profitable with air freight. So that's definitely something that you have to consider. And at Guardian, we're forced to use ocean. There just wasn't another viable way. So that placed even more constraint on having to place bigger orders than we would have to otherwise.
Yeah, well, that's super interesting. And the Chinese New Year thing definitely throws a wrench into so many plans, especially when it comes to, like, if you're working with finite capital in the first place and you're trying to, like, buy as much as you can for Q4. But in theory, if you sell out in Q4, well, you have product to sell in Q1. That's problems that we've seen with brands in the past too, where you start having conversations about incrementality, where it's like generally November, December for many brands is going to be some of the highest incrementality periods. But do you want to leave a certain number of SKUs left over on purpose for Jan, Feb, March, where even at 20% of the spend, are you going to get more profit per unit sold? And profit per unit sold isn't like a metric I think a lot of people think about frequently. But when you have finite inventory, because you might be waiting to get inventory for months, I think it starts to matter a lot more. So definitely something that we commonly see occur.
Yeah, for sure, man. I mean, I know we've talked about this a little bit, sort of like tangentially here, and I feel like there was some other episode we had a discussion about this, but like, what are some of the things when you think about let's talk about the risk of the demand forecast, right? And so a big part of the risk has to do with understanding probabilities and uncertainty. Like, how much uncertainty is there? How likely is this, right? How unlikely this is. Like, being able to assess probabilities is super key for assessing how risky a given demand forecast might be. What I can think of a few things that come to mind when I'm thinking about how to assess probabilities, but what are some things that come to mind for you?
Yeah, so thinking about Q4 and thinking about like confidence in base case forecast, the biggest thing comes down to LTV and percentage of customers that are return versus new. That's going to generally be much more accurate to forecast. And then second is actually going to be like margin left on acquisition. We work with some brands that actually can have a huge total addressable market, but front end acquisition profitability is very thin. Now that can be okay, but all of a sudden, if it gets 10% less efficient and you have limited return customer revenue, you're talking about like the scenario you just alluded to earlier, like the downside scenario might be 50% less than base case forecast. Now, no one wants that to happen, and no one thinks it is going to happen, but the margin for error is so thin that you basically have no choice but to execute. And execute could also be impacted by external factors, be it the market, et cetera, et cetera. Totally. So when thinking about like the high risk brands, I think that's when you really have to have a more like honest conversation with yourself as an operator of like, yes, I'm in that category, so I should adjust my PO accordingly. Like if your 12-month LTV only goes up like 10-20%, red flag. Doesn't mean you can't win, just means like your revenue, your forecast is inherently probably going to be riskier. And the second thing is how much how much profit dollars do I have left in acquisition? And if it's really healthy, that's great. Maybe you can have a bit more confidence, even if a bad scenario happens and all of a sudden all your historical forecasts are wrong by 10% or insert some like sensitivity here. I think that I can still basically push for that volume. I'll make less per unit sold, but I'll still make profit and I have that buffer. So the safe with brands are high LTV brands that are first order profitable and like healthily first order profitable. Surprise, surprise, that's not the majority, but the best brands tend to fit that bucket. On the complete other side of the risk curve is like a brand that's very first time customer dependent. And you can get even more risky if it's first-time customer dependent with a very diversified set of SKUs. Because what can sometimes happen in those brands too is you have like one or two products that just rip during Q4, and the second you sell out of those one or two, the volume kind of just like flips. So I think that like if I'm a first-time customer dominant brand, I'm definitely going into it more conservative. I'm thinking more about downside risks and trying to make sure that like how I'm financing it all makes sense and is feasible. On the LTV side, I'm definitely more open to being like risk on, and I think you can more easily justify the risk in Q1 because you'll probably have a better vehicle for actually moving through those excess units.
Yeah, I'm reading this book right now about investing principles and like investing strategy. And I love it because it's very applicable. Doesn't matter where you're investing, right? And it's very applicable to what we're talking about here. And like one of the principles, I've always known this, but it was like kind of like really anchored this principle in my brain as I was reading through this last week, which is like time is an investor's best friend, right? So that's specifically why I say don't let your debt mature right after you figure out if you're right or wrong, because you don't have time, right? And so like another way that this book puts it is like time heals all wounds, right? If you have the time to wait out, a stock market correction, for example, you could put all your money in the S&P 500. And if your investment time horizon is 20 years, it doesn't matter if it dropped 20% for 6 months. Eventually, in 20 years, it's going to go up by 8 to 10% annualized, right? Compound growth rate. It's the same thing here is like, you really need to ask yourself, like, how much, if this doesn't go as planned, right? If I don't sell as much product as I thought I was going to, how much time do I have to let this correct itself, right? And the factors that you just talked about are several different factors to consider in terms of like how likely or unlikely it is for time to heal the wound of being overstocked after Q4. A couple other things that we've talked about, I think we talked about this on the last episode about Q4 holiday, was just like, is your product going to go obsolete, or does it have a shelf life, or is there a seasonality to where like you sold a product during Q4 that doesn't get sold seasonally again until next Q4? Much different. I know some brands that like, they know for a fact that in April, in the spring, they're going to crush it again. So they only need to hold on for 3 to 4 months after not hitting their sales goals. But I know other brands, apparel brand that I work with, we're waiting until October of next year. So they got to wait 10 months, right? Those are different waiting periods for this, for things to self-correct. And so anyways, very, very important to assess those things to then back into like, how risky is my sales forecast and how risky is this decision I'm going to make? There's one other thing I wanted to just mention, which is like, I was actually talking about this with your business partners, Liam and Jacob, a week or two ago. We were talking about inventory planning process. And one thing that I was mentioning to them was like, hey, one issue that I see happen a lot is you may get the demand plan. You may have a good plan or you may have a good process for demand planning at the SKU level. That being like, what do we forecast is going to get sold by SKU over the next X number of months? But to calculate the replenishment plan, the PO, you have to factor in the supply you already have. And I want to mention this because you can get the demand plan nailed and be wrong on the supply that you actually have, which I actually see all the time, that like brands don't have a good, accurate snapshot of, here's the thing, it's not just one bucket, what's on hand in the warehouse, what's in transit to the warehouse, and what's open on PO that has yet to be shipped. Because you really have to add all of those up, what's on hand, what's in transit, and what you've already ordered but hasn't been shipped yet, to get your total current supply. And if you don't have a good process for measuring those snapshots with accuracy before you turn your demand plan into a replenishment plan, you will over or under order because you think you have more or less stock on hand than, or available or soon to be available, than you actually do. And so do not discount that, because you'll put all this work into a solid demand plan and get a garbage replenishment plan.
100%.
Any final thoughts on demand and replenishment planning?
I think that like outside of Q4, just like in general, this topic doesn't get enough focus. A lot of brands run on like net margin targets or contribution margin targets. I mean, on the ad side, it's often contribution margin. A lot of businesses that have net margin targets, but I think a lot more brands should also think about like how much cash flow can actually be like retained and distributed out to the shareholders. And ultimately that really comes down to how effective you are at placing your inventory bets and getting an actual ROI in those inventory bets that you place. And I think that thinking about how can you basically build like a cash flow optimized strategy across your business, all the way from how much you buy of what, but down to how you actually then liquidate excess inventory. I think that like one thing we're trying to do at Aplo and thinking about a lot lately is like, knowing we tend to run on contribution margin targets. Like that's like the end all be all goal that we're optimizing for when trying to go for growth. But I think like a secondary metric that might be like just as important is also like how effective are we at moving the right units at the right CAC or the right speed. I really think that marketing and like demand planning really fit hand in hand in that regard. And I think that when you're working with a marketing team, whether it's in-house or an agency, actually having a system or a framework in place to communicate which SKUs should be moved. Like an example of this is like maybe there should be an automation on your email sequence that is essentially automatically pushing products that are labeled as overstocked because the estimated days sell through is X, Y, or Z. Like there's lots of things that I think that like we as the marketing agency can do better, but also systems and frameworks that we can collaborate with brands more. So I've been thinking about this a lot lately because I think I just hate to see overstocks happen. They happen. They're going to happen. But
Yeah,
the less frequent they can happen, the better.
totally. I'll say like final thoughts on my end are, remember that there are constraints and strategic considerations that will force you to go outside of the quote scientific, like optimized quantity you should order. You should have a system for calculating methodically using historical data what you should purchase, but you need to consider capital availability and cost of capital, like key components you can't stock out of, subscriptions you can't stock out of, and other supply chain, constraints that may force you to adjust the order quantities that you're purchasing. But at the end of the day, just remember you're placing a risk-adjusted bet. So come up with a framework to assess risk and adjust your bet accordingly. So anyways, man, episode 19, that's a wrap. We're coming up on episode 20.
And it's almost time for Q4. This is the fun time of year.
Heck yeah, man. I'm already looking forward to the next one.